Hello everyone, Professor Christensen here. Today we're going to take a look at accounting for notes in a case where there is simple interest. So by the end of this video, we're going to take a look at recording notes receivable and payable when the loan is made. So when it's first borrowed, when the money's first borrowed, or when the money is first loaned, depending on which party we're looking at. And then we're going to learn how to accrue interest at year end. We're going to record the repayment of the note in the following year with the interest. And then we're going to use references, simple formulas, and the sum function in Microsoft Excel at the same time. All right, so let's take a look at what we have here. So here is our data. So we're looking at an accounting firm that is expanding to help finance the costs. It's borrowing $250,000 on March 1st, 2021 from First Bank on an 18-month loan. Interest will be paid when the loan is repaid, and here are the details of the loan. So the loan amount is $250,000. The term is 1.5 years or 18 months, right? And then the interest rate is 7%. All right, so our requirement is using references and formulas for all of the numbers, record the following transactions. We want to make sure our numbers are all formatted accounting with no decimals and no dollar signs because we're making journal entries. Okay, so let's take a look at what we're doing. The first thing that's happening is Asante, so this is the CPA firm, is borrowing the money on March 1st. So they're borrowing the money. That means that they're getting cash, right? And cash is an asset, so we're debiting cash. How much cash are we getting? We're going to type in equals, and we're going to reference the loan amount, which is $250,000. We know our credit has to be equal to our debit here because we're going to be crediting the borrowing, right? This is notes payable. So this company now has a note payable for $250,000. All right, next up we're going to record the accrual of the interest at December 31st, 2021. We know that we borrowed the money on March 1st. Remember, watch your dates and rates. Dates and rates. All right, so how many months interest do we owe at the end of the year? So starting with March, I always tell my students count on your fingers. March, April, May, June, July, August, September, October, November, December. 10 months, okay? We borrowed March 1st, and we're recording interest for those 10 months. So when we accrue interest, we're going to debit interest expense, and we're going to credit interest payable. Right? Because we have an interest expense that we didn't have before because we owe this money, and the payable is telling us that we owe the interest. And this interest expense is going to go on our income statement, and the interest payable and the note payable will go on our balance sheet because those are both liabilities. Okay, so our interest expense, remember interest is equal to the principal that you borrowed times the interest rate times the time, and the time is in terms of a year. Be very careful with the time in notes. That's the thing that always gets students. It's the time. Okay, so our interest expense is equal to the principal, that's how much we borrowed, times the interest rate times the time. And the time in terms of a year is 10 divided by 12. All right. So it's the principal times the rate times the time. So, okay, I'm going to, remember this said, let's format all of these numbers right now because it said format the numbers, accounting, no decimals, and no dollars, right? So we want it like that. So we don't need all those decimals. All right, our interest payable is equal to our interest expense. All right, so now we have our note that we borrowed, and then we accrued our interest at the end of the year. Now on September 1st of the next year, we're repaying the note. So what's going to happen? We know we're going to have to pay cash, and we're going to pay 3 different things. So we're paying off our notes payable, right? We're not going to have that anymore. we're paying off the interest payable from last year, right? This interest is 2021 interest. So we're paying off that interest that we owed from last year, but what else do we have? Well, we owe some interest from this year, right? And remember, last year was 10 months. Let's just remind ourselves. This is kind of a check that you can do because we know that we have an 18-month loan. So we had 10 months last year, so we better have 8 months this year, right? So our interest for 2022, we're going to call interest expense because this has to do with 2022. And so now it's January, February, March, April, May, June, July, August. So it's 8 months worth of interest. So 2022 interest is 8 months, right? And so in total, our loan is 18 months. So we're happy, right? We know that we've accounted for all 18 months worth of interest. All right, again, we're going to do principal times rate times time. The principal is $250,000. The rate is 7% times the time. And in this case, the time is 8/12. Okay, so our interest is $11,667. We're going to credit cash because we're paying all this stuff back to the bank. Now here we're going to add these three up. There's a couple ways to do this. You can do auto sum by just clicking up here and then just tell Excel the three things that you want to add up. Or you could type in the sum formula, which is going to look just like that, and you're telling it add up these three numbers, C25, 26, and 27. That's how much cash we have to pay, $276, $250. Okay, now if you want to make a double check to make sure your interest is okay, one thing you could do is, let's say how much interest we in total, right? So our total interest should be equal to our principal times our rate times 1.5 years. So our total interest is supposed to be $26,250. And let's just double check that that's what we have. We have $14,583 plus $11,667. All right, our total interest that we've recorded is $26,250. That's a little check. So now we know that we recorded the correct amount of interest. The total interest, $26,250 for the year and a half. All right, so we are all done from the borrower's perspective. Now we're going to do the same thing for the bank. Now the bank is lending the money. All right, so we did the hard part. We did all the calculations. So now all we have to do is look at the mirror image. So in the world, if somebody has a note payable, someone else has a note receivable, right? So in the case of the bank, again, let me format these numbers so we know that they are accounting. No decimals, no dollar sign. Okay. All right, so the bank has a note receivable. All right, let me make sure these are all formatted the same as the other ones. Okay, and when the loan was made, the bank credited cash for the $250,000. Let's reference it back to here. Okay, so the bank is paying out cash and it has a note receivable on its balance sheet because Asante Company owes it the money. All right, and they paid out the cash. All right, so now at the end of 2021, the bank gets to record interest revenue. So let me just remind you, this is why you can't debit or credit something called interest, which is something students do sometimes. You can't just say interest, right? Because we're going to see we have interest expense, interest payable. Now here we have interest receivable. And because they are paying us interest, this is revenue to us. Interest revenue is getting credited. All right, and I'm just going to make this equal to this because it's the same amount, right? The amount that they record as expense, we record as revenue. All right, so that's why you can't just say interest, right? Because it could be 4 different accounts. Okay, so now on September 1st, the bank is getting paid cash, right? So it's getting paid $276, $250, and it's going to credit notes receivable which is the same amount as the note payable. It's also going to credit the interest receivable that was recorded before. That's the 14,583. And then it's going to record the interest revenue for 2022, and that's equal to this 11,667. Okay, so now the bank mirror image, everything is the mirror image. It has revenue and receivable, whereas the borrower has expense and has payables. Okay, so now we want to make sure that we used Excel properly. So we're going to change the data, and this is why it's really important to use references and formulas when you use Excel. So I have this set up so that if you put in the correct amount, it's going to tell us that it's correct. So now we're going to make the loan $500,000 and the interest rate 4.5%. So you can do anything with this, right? You can do any problem, and as long as you change the numbers up here and you did everything properly, all of the numbers change for you. So the question here is, how much will be repaid? So we say how much is going to be repaid. It's $533,750. Voila, that's correct. Okay? All right, so now you should be able to record notes receivable and notes payable with simple interest. There is compound interest. We're not looking at that today. That's a totally different animal and all different calculations, but this is simple interest for both the borrower and the lender. All right, I hope you find this helpful in your studies, and happy accounting. See you in the next video. If you enjoyed it, please subscribe to my channel. Thanks a lot. See you next time.